All right, let's get started. How is everyone doing today? Okay, so today's webinar is going to be a little bit different. You guys can see that I have some different topics. But again, I'm glad everyone is here, so thank you to be here with me, taking this time. Hopefully I can deliver some good content and some good material for for everyone that is watching this webinar now or even later on YouTube. The weather is not that good here in Sydney, but who cares, huh? So today we're going to be talking a little bit more, looking at today and comparing us tomorrow, and because what is just happening on the market feels very familiar for me. And that's exactly the title, what just happened in the market feels very familiar. It feels very familiar for me because we've been to that stage before. All right, we've been to these sort of tariffs, we've been to Trump administration before. So everything looks a little bit similar as it going before. Okay, so I'm going to be talking a little bit about like a deja vu in the charts. Twists on tariffs. No one was expecting something that Trump just said over the weekend. Actually, I think I've talked with that on Tuesday. It wasn't Trump that actually talked that, but we're gonna get there. The reality versus the hope rallies, because everyone is expecting a rally. Okay. Even if we look to Nasdaq, S&P 500, China 50, all of those indexes, they've rose a little bit. They sort of jumped a little bit, but nothing too crazy, and then came back, and then now rally again. So that is like a hope. There's a hope into the market that the market will get back to normality again. And of course, there's the reality. I like to trade with the reality, and I don't like to trade with the hope of a rally. Okay, so we're just going to talk about that. The cows from the White House just so before we get live, 4:51, Donald Trump has posted something that we're going to be looking in a minute, but it was very interesting, very, very interesting, because he said that whatever if the Canada and China try to put tariffs back on him, they're going to have a big problem. They're going to have a really, really big problem. Okay. And they will be, and USA will be fighting back as many as tariffs. So that's going to be really interesting. And I'm really interested to see how this is going to lead. Okay. And then, of course, last but not least, the global context. What is happening? What's the context? Pretty much putting all together and then going from there. So yeah, I see that one person is new here, so welcome. If you have any questions, if you want to ask me questions or anything like that, you literally just send me the chat on the messages here, or you can even unmute yourself and just talk to us if you want to have if you have anything to add as well, or anything like that. All right, cool. But as usual, guys, before we go any further, I have to put the risk disclaimer up. So I'm going to give a minute or two for everyone to have a look at the risk disclaimer, and then we'll be back, and then we're ready to go and ready to start the webinar. Okay, be back in a second. Okay, right. Let me take this off. There we go. And I want to start with the deja vu in the charts. Okay. Cool. Let me take this off. Perfect. Where it is? Not here. Let me get it. Okay. If we look to S&P 500, okay, that's a daily chart now. 2021. Let's go back to 2021. Yes, 2021, it's a long time ago. Well, not that long, but here we go. 4th of January 2024 on this white line until December 31st, 2021. There you go. During that period, during this period that we can see right here, the market were every single month putting all-time highs again and again. Not all-time highs, but higher than the previously. So we can see here, this is the beginning of the year in 2021, and then we had right at the start a high, and then high again, and then this one higher again, and then higher again, and then we had a breakout. We can see that we had the breakout and on the right of the top. For those who trade technical analysis, you can see I hadn't showed a thing here inversed. I don't really like that, but anyways, you would get stopped out, as you can see. But anyways, it is what it is. Okay, so every new day or every new week we were hitting new peaks, and that was fulfilling the investors' optimism. But however, that euphoria was like a short-lived euphoria, okay? Because we can witness the breakout as we saw, like a failed breakout, as I can see. And then we had this sharp sell-off that caught a lot of investors off guard. Okay, so and then we transitioned to early 2022. So what I'm trying to show is every time new highs, and then we had a breakout, a failed breakout, and then boom down, and then we break the bottom, and then continue to go lower. Okay, as we go into 2022. Let me take all of these drawings off. So now 2022 to 2023. Okay, so 2023 right here. So 31st of December to 3rd of January, we saw the whole year. We start the year right at the top here, okay, right at this top. And then we saw the market closing right at this bottom. So that pretty much gave us somewhere of negative 20%, okay, 19.99. Yes, there were periods that we were even lower, okay, like here in 25%, but we ended up closing the year into 19.99 or 20%, pretty much that, okay. The Federal Reserve in 2022, they announced the impending rate hikes to combat the raising of the inflation, which marked the onset of a bear market. So that was the biggest reason why we had this whole move down. And because the Federal Reserve came in and said, look, guys, post-COVID, we had that really high inflation. So for this reason, we're going to be starting to rate the interest rates, to hike the interest rates. And then, investors usually don't buy S&P 500 or anything that is risk-on mode on these type of periods. They used to go for Swiss franc, they go for US dollars, bonds, etc. So even if we place the US dollar here, we can see that it's completely opposite move, right? Right at the beginning of that 2022, we had a move down, but then we had an appreciation for 2022 all the way to 2023, an appreciation of 13%. And the peak was 27%. Okay, right at September. So pretty much 9 months, you would have been made 27%. That's crazy good. All right. But that's exactly what we're seeing. In blue, we're seeing the S&P 500. In pink, we're seeing the US dollar. So basically, that's the best interpretation of risk on and risk off. And if you've been here on Tuesday, that's exactly what I've mentioned as well. The risk on and the risk off. The market is risk off at the moment. It would be even crazy if I put the gold chart here, okay? Because we can see that gold was going all-time highs in 2022. So let's have a look at it. Oh, wait a minute, that's wrong. I was wrong. So in 2022, we began the year on a 15% increase, and then we had all the way down, but we ended up closing positive, if I'm not wrong. Oh, well, we literally closed like 1.7%, 1.7 to break even. So not much of a change in gold, but we can see that, when the central bank announced right at the beginning in February, the rate hike, we saw the market going up. Okay, we can see this right here in February, 1st of February, on this bottom, the market went all the way up. So that's the move I was trying to show you guys, not the whole year, but just this move here. It's when the Federal Reserve announced, look, inflation is high, we're going to continue, we're going to start to increase rates. Now, that being said, let me take gold off here. Cool. So we still have DXY and S&P 500. So basically, if we fast forward to February 2025, where we are at the moment, okay. So 2023, let me just do one more. 2024 right here. And then 2025. Perfect. So we saw the US dollar rising and then falling back now in 2025, but we continue to see the S&P 500 rising. Okay. So we have 21 to 22, 23 to 24, and 24 to 25 now. Okay, so what if you look at it, what can you sort of see? What can you look at it and then you think, okay, there's some similarity here. Remember, 2021 to 2022, 2022 to 2023. When we got the right of the hikes from the rate hikes from the FOMC, from the Fed, and then investors were risk on, so they continued to buy US dollars, but they were shorting the S&P 500. Okay. Now we have on 23 to 24 actual consolidated US dollar. 24 to 25, we have a consolidated as well. And then now to 25 to 26, we're probably coming back down on US dollar. Okay. So if you look at it, down, up, down, up, down, we're probably coming back to 100,000, around 100,000 on US dollar. Okay. And let me just take all of these drawings off now and take this guy off. And with the S&P 500, exactly the same happened in 2024. We've seen an up move, up, and then a false break and all the way down. So what can possibly happen here is S&P 500 decreasing this year, okay? Most likely decreasing this year, and the US dollar as well. That would be very interesting and very rare, but I'm just suggesting that is a possibility. Okay, so that's what I say. It looks like a deja vu in those charts because it feels like I saw that before. But now we're seeing the beginning of the sell-off. Okay, it's not all of these. It's just March, guys. We're going to April now. There's not 9 months. But this time, I think the catalyst is a little bit different. Isn't just the monetary policy, it's the trade policy. It's from the Fed, and it's not just, all right, it's not just the monetary policy. It's the monetary policy plus the trade policy. So it's the Fed with the tariffs from Trump. Okay? Now, there comes to a twist on tariffs and the trade tensions. So beginning of this year, the narrative has been shifted. Okay, so President Trump administration, they introduced the tariffs targeting a lot of sectors, including, cars, like automobiles, semiconductors, pharmaceutical, and a bunch of other things. But this move isn't just a blip on the radar. Okay, it's not just like a blip on the radar. It's a structural change with far-reaching implications. And I've literally mentioned that a long, long time ago. Be careful, because no one will be, oh, okay, yeah, you're going to put tariffs on me. Cool. Yeah, you just put tariffs on me and we're going to be friends forever. I mean, come on. You will put tariffs back on that person, all right? That's just a really bad example here, like a really, really stupid example. But if someone punch you, you want to punch them back, right? So that's exactly what is happening with US, Canada, China, Mexico. And US basically punched Canada. Canada punched him back. And then US punched China. China punched him back. Mexico, same thing. Okay, so the tariffs are a problem to basically disrupt the whole global supply chain. Okay, the whole global supply chain, and that is introducing, of course, inflationary pressures, and that will be squeezing the corporate profit margins. So, is it good? 1 to 2%. Is it bad? 98%. All right, so. In a sense, yes, it is a little bit good because, the country will be producing more for itself, and it will be getting more money from other countries. But it's bad because it will be generating inflation. People will be spending more money to buy the exactly same product that they were buying 5 years ago for $5, and not only because of the inflation, it's because of the tariffs that make the product more expensive as well. So remember, on the automobile industry, if a car used to cost $100,000, now there's a 25% tariffs on top of this. This car will be costing $125,000 plus the inflationary pressures of 5 years. Okay, so that's really good. No, that's really bad, but it's good for the country because they will be, getting more cash flow into the bank account. So the administration message is really clear: manufacture in US or face financial penalties. Okay, so that's exactly what the administration from Trump say. Manufacture in US, or you're going to be facing penalties. And this instance, I think it challenges the established global production models because many companies, they have relied upon decades on US. Okay. What did Sweet say? So let's have a look. Sweet says that, to me, if the other country could strike back with tariffs, then it's pointless for Trump coming up with such ideas. That's a really, really, really good point. And that opens space for discussion as well. Because if you think about, right, you have a country putting tariffs on you, and you put a tariffs back on them. Who will benefit the most? No one. Because it will be literally like hedged, So it's basically a power, sort of a power. Who has more power? I have more power or you have more power? So let's fight. But let's fight on a trade war. It feels like it's not good. It feels it's the best threatening people when they have nothing new. Yeah. Okay, so continue. So the market reaction has been very uncertainty and very concerned. Okay, the whole market has been very concerned, very uncertain of what's going to be happening. A lot of investors are very worried about, they're recalling how previous policy shifts led to market volatility. So there's a lot of changes happening. And the question that everyone is keep asking themselves is, how deep will these trade tensions go? And what will be the long-term impact on the economy? Because I even asked those questions for me, like, how deep can this go? And that's exactly what Sweet says and what I've, sort of had a chat. If we keep going the way we are, we're going to stop. When are we going to stop? Are we even going to stop? Are we going to have tariffs forever? That's a big problem, and how deep can it go? 25, 40, 50, 100. Things are very, very strange at the moment, okay? And that's the impact of reality versus the hope rally, okay? So despite the news from everywhere, I think I've observed a bullish reversal and days where the market seems to be rebounding, like today. We saw this little rebound here of 4%, but that's literally nothing for pretty much 12% drop, if I'm not wrong. 10% drop. So I think it's crucial, okay, to approach these rallies that we're seeing at the moment with a lot of caution. I don't think it's okay, it's going up, let's buy it. You think it will go up, or do you think it's just a pullback? I mean, there's ways and ways. Like, there's a lot of people that look at candles, and it's very simple for us to see there's much more red candles, even on the up move. Okay, so, and those candles are very big as well. So it's interesting. Anyways, if we sort of examine the reverse of this trend, so this uptick here, it reveals that these upticks often they lack strong trading volume, and that is suggesting for me that it's a very fragile foundation for a big move that possibly can happen or something like that. So a lot of technical indicators, they're flashing a lot of warning signs. Short-term charts show overbought conditions. Patterns we saw in 2022, they're all presenting itself again. So for me, it suggests that we might be entering a cycle characterized by lower highs and lower lows. And as we all know, that's a bear market. So welcome to maybe a bear market, in my opinion. Okay, so this may be a potential pullback to be shorting indices, or maybe even continue to long gold, okay? I think the economic data, it further supports the caution outlook. A lot of people are beginning to think that we're going to be having a recession on US. The purchasing, the PMI, the Purchasing Managers Index, it's indicating that input costs are rising a lot higher than expected. And of course, the companies will be finding it challenging to pass this increased cost onto consumers due to the competitive pressures, and that will lead to a margin compression. And that scenario possesses a lot of threat to those corporate, and of course the stock valuation. So if NVIDIA, let's say, can't pass it over the cost of a RTX 4080, then they're going to be suffering with that, and they will be sort of short squeezing themselves, that the earnings won't be that good. And once the earnings are released, then the stock goes down. That's a possibility. Okay, I'm not saying that this is going to happen. but I think there's much more to it. So yesterday, or was Tuesday, can't remember now. I think was yesterday maybe. So I've talked about gold. Let's go to the 1 hour chart. So we see gold somewhat consolidated here on this area. And we can see that investors are keep longing it, okay, for only one reason. Does anyone know the reason? I'm going to give 1 minute for everyone to send a message, or for those who want, to tell me the reason why gold has been going up. It doesn't need to be a really, really huge thing. Just the smallest as you can, but just tell me. Sweets, come on, Sweets. I've told you that. Tariffs cause inflation. Just do it. You're getting there. Just do it. Gold is a good hedge against inflation. There you go. What a man. See? Yes, that's the first point. Gold is a hedge for inflation. Around the world, if you want to hedge your risk, I'm not talking about us, that have maybe $1 million, maybe 100,000, maybe $1,000 account. I'm talking about people that has 100 billions of dollars. Okay, banks, institutions, everyone. That's the perfect spot for them to hedge against inflation. Why? That's the exactly answer I want now. Why is it good to hedge against inflation? Maybe you guys don't know that, so I'm going to go and step in here. But basically, remember, I think I've told you, Sweets, this Tuesday or Wednesday, risk on and risk off. Whenever there's risk on the market, basically investors are willing to take risk. And for that reason, they will be looking to trade on the market. They're literally looking to S&P indices, really high risk, sort of high risk and high reward sort of asset classes. But then there's risk off. They will be looking to commodities. They will be looking to bonds, fixed income, real estate, etc., etc. So that's exactly what happens when there's a high inflation and there's a fear of recession basically happening. Especially on US, and there's a trade policy war happening as well. We have like Trump, having a trade war. Let's call that the trade war pretty much. What do you think it's going to happen? Well, I don't know. I don't have a clue, because if I knew, that would be fantastic. And that for this reason, that's the reason why people are looking to go into gold, because it's an inflation hedge, plus it's an uncertainty sort of hedge as well, if I can say that. Okay, so yes, Stuart is correct. It's because of the inflation, plus of course because of the uncertainty and fear of what's going to happen next. I don't have a clue. Okay, so that's the mainly reason why gold is going up. Of course, central bank buying. It's another thing as well. China has been one of the biggest, and India as well, and Turkey as well have been one of the biggest buy of gold. Most likely gold will continue to rise, maybe a small pullback until somewhere the levels of 3,000, and then a continuation up. Let's see how this goes. Okay, now moving on. The policy uncertainty and the market volatility. All right, so that's just another layer of complexity for the market and for the recent missteps within the administration of Trump. I think the reports that have been surfacing, the US officials that used to unsecure the communication channels to discuss sensitive military operations. Someone should join us. Cool. I don't know if you guys heard about, there was some data leak from US because of the, unsecure communication channels where they were discussing sensitive military operations and inadvertently including unauthorized individuals in those conversations. Lapses not only raise concerns about national security, but it also contribute to the growing sense of unpredictability in the policymaking. So that whole atmosphere of uncertainty, of not knowing what's to come, can have a very tangible effect on the market, and investors will crave stability and predictability. When policies appear erratic or poorly communicated, it undermines the confidence, leading to the increased market volatility. So that's another reason why gold has been going up as well. And we have a lot of money flowing to China and from Europe. Okay. So now, I think I've gone through a lot of different stuff today, but just setting up the global context, Europe, China, and the big pivot that I've been talking a lot about Europe. I've been talking a lot about China, but I didn't have like how can I say that, a focused, dedicated time to talk about them. So there's a lot of global economic landscapes that are suffering challenges as well. It's not only US, but Europe is grappling with energy crisis and political uncertainties. That there's some threatening economic stability. China, very significant player in the global economy, is facing deflationary pressures and some structural issues that could have ripple effects worldwide. And those sort of international dynamics, they're very crucial because they can influence, not they can, but they will influence, if something happens, the whole global trade. Investment flows, economic growth, and whatever else. So the US adopts a much more, protective stance. Of course, they're just trying to consider how these global factors will interact with the domestic policies that they're doing. But I think that this is all interconnected today's economies, and that means that shifts in one region, they will have a profound impact into another region. So whatever happens into China will happen something in the whole world because it will move around everything. Okay. I think the investor sentiment now, it's very powerful force. And despite the current volatility we're seeing, some investors remain very optimistic, of course. They're continuing to heavily invested in US stocks. And for me, this behavior pretty much mirrors the patterns that we've seen in the past, where a lot of retail investors buy into the dips, expecting the rebounds, and then the market continued to fall. So that's exactly what I've been telling everyone. Be careful. That's not a beginning of a higher trend. No, it's probably a continuation of a lower trend. However, it's very important to balance, the optimism and the realism. So the reality against the optimistic. I think majority of the forecasts have been seen of the recent developments for like Barclays, Barclays. They reduced the S&P 500 forecast for 2025, saying that there's a lot of uncertainties around trade policies and the potential for economic impact. So for those reasons, they will be adjusting down. So they're not predicting anything higher this year. They're predicting, if something happens, it's predicting to go lower. Just showing that those adjustments will reflect a broader trend of trying to recalibrate the expectations to align with the market conditions. So where does this leave us today? I think the current market environment demands a lot of patience, a lot of vigilance, adaptability as well, and a lot of commitment to staying informed. because anything can happen at any time. And just before we go, before we finish, I want to show something I will present to you guys very soon. But why it's very tempting to seek opportunities, on those volatility periods, it's equally important to see that there is a lot of risks to proceed, with the volatility, to come with the volatility. So I would suggest to you, have a look. Is that really what you want to do? Okay, so stay informed and see how this goes. I think history has shown us that the markets are very cyclical, and there's periods of growth, and then we have followed with periods of correction. And if we start the past patterns and understand the current events and anticipate the potential outcomes, we can make more informed decisions. So let's remain very informed. Continue to monitor the developments very closely. And if you guys always need help, I will be available on Telegram. Okay, guys, thank you so much. I hope everyone have a beautiful weekend. This hopefully sunny where you guys are, and can go outside, or even raining if you like rain. It just depends what you like, huh? I guess. So thank you so much, everyone. Have a lovely day. Have a good rest of your week, and I see you next week on Tuesday. Cheers, guys. Bye-bye.